Welcome back. Above 19,400 on the Nifty, courtesy the rally that we've seen in the banks in the last 1 hour. But where are we headed from here? Nirav, Sheth, CEO, Institutional Equities at Emkay Global, is with us on the show. They've just recently concluded Emkay Confluence, where they hosted more than 150 companies over the last 3 days, and it was titled Unleashing India's Potential. Nirav, thank you very much for joining in. This is here. Just quickly summarize the top trends. What were the key takeaways for you? The top 5.
Well, if I have to sort of summarize, one thing is that the companies are far more bullish and the investors are far more skeptical, right? So that's a clear disconnect over there. But if we go to sectors, for example, you would assume that in a rising interest rate scenario, you would expect banks to be more cautious. Our understanding is that most of the banks are slightly more bullish in terms of the credit outlook. You probably have the best cycle around the asset quality that one could hope for. We believe that the manufacturing seems to be certainly in a different sphere altogether, especially the EMS companies, even the infrastructure companies. So broadly, there are a lot of new companies, a lot of small and mid-cap companies. It essentially tells you that the India Inc. seems to be on the right path in terms of the outlook on the growth, in terms of the profit, in terms of capital productivity. You could have minor, software, for example, stands out that, they continue to be slightly more cautious in terms of outlook. Outside that, I think, barring, few sectors, the mood was fairly robust within the corporates for sure.
Okay. Okay, got that. Nirav, thanks a lot for joining us. This is Pavitra. If you could just get a little bit more into, some of those calls. I know on technology we have spoken before, but take us through how it's looking now, because yes, we did get those severe guidance cuts after Q1. There is, of course, global nervousness as well, but a lot of the stocks seem to have come off the low significantly. Do you think the worst is in already for technology, and from here perhaps it could pose a good buying opportunity?
Yeah, so I think we've got a slightly non-consensus view over here. We are fairly optimistic in terms of the investment prospects in software, and I'll tell you the reason for that. It is largely a macro trade, right? So you need to be slightly more bullish in terms of how the global economy is going to play out. We believe that even the recent backup in yields that you've seen in US is largely a function of better economic data rather than poor inflation prints, which means the real growth is higher. We have no doubt about it that the real investment in software is going to be a macro trade. If you are going to look at micro developments, which is in terms of what the clients are going to tell you, I think you'll be late in the game. I think our understanding is that you will start seeing slight upgrades in earnings starting from Q3 and almost certainly by Q4. If our assessment is right, then probably the stock price will start reflecting somewhere right now. So I think we are in a very, very interesting space. That's number one. Essentially saying that, how fast the macro developments globally will start reflecting in terms of the micro outlook for the software companies. But you also have to keep the valuation context in mind and where the Nifty is, and related to that, where are my valuations for the IT sectors. Both these things in context gives a very strong, makes us fairly bullish on the sector.
Okay. Nirav, stay on. Want to talk to you about some of the trends we're seeing in the broader markets and this huge rally that's playing out. But before we get to that, the anchor lock-in period for a lot of companies that recently listed, over the last 12 months or so, that anchor lock-in period is ending for several of them. In fact, for the recent listing NetWeb, the 1-month lock-in is ending today itself. We have Horma standing by to put all of this in perspective. Horma's.
It's almost kind of nostalgia, right? Because sometime during October and November last year, there was a slew of companies that had their lock-in periods ending around October and November. And it's happening, the same thing is happening this year as well. Now, as per a Nuvama note, there is a total of 37 stocks whose lock-in period is ending today, but starting today until the 31st of December. But more than the 37 companies, what's more important is that 227 crore shares will be eligible for trading once once their lock-in period ends. Now, this lock-in periods range from 1 month to as long as 3 years. But I'd like to begin on a different note, and I'd start with India's largest IPO, which is LIC. And that's because out of the 227 crore shares, 126.5 crore shares belong to LIC. And those will become eligible for trading once their lock-in period ends on the 13th of November, which is when it will complete 18 months of listing. Now we'll move on to the recent listings, and as you mentioned, NetWeb Technologies has the lock-in period, the 1 month lock-in period, which is opening today, and that stock will have 20 lakh shares opening up, which will become eligible for trade. And the others in the list include Yatharth Hospitals, SBFC Finance, Concord Biotech, which is backed by the late Rakesh Jhunjhunwala, and they will have their lock-in periods ending anywhere between the first week to the third week of September. And of course, these same stocks will have their 3-month lock-in period also sometime during October or November. But besides these names, a standout in the 3-month lock-in list is going to be Utkarsh Small Finance Bank, where 4.5 crore shares become eligible for trade once the lock-in period ends on the 16th of October. Now we move on to the 6th month bid, and in this list, more important than the number of shares, it's the number of outstanding, the percentage of outstanding shares that take center stage. And another standout in this list is Mankind Pharma, and shares have almost doubled from their IPO price. Now once that lock-in ends on the 6th of November, 70% of their outstanding shares will become eligible for trading. Now on the 1-year list, Syrma SGS is the stock whose lock-in period ends on Friday, and which will free up nearly a quarter of its outstanding shares for trading. And other names in this list include the likes of Kainis Technologies, Dhamraj Crop, and others. Now in this 18 to 24 month lock-in list is where I mentioned LIC to you, and aside of LIC, there are other stocks also like Campus Activewear, Star Health Insurance, which have not done much since their IPO, and in fact Star Health Insurance is even trading below its IPO price. Now even some of those outstanding shares will also get freed up for trading. Now lastly, the 3-year list, it comprises of almost all the runaway hits we have had this year, like Happiest Minds, Angel One, Mazgaon Dock, and all of these names will have 20% of their outstanding shares which will become eligible for trading. And it will be interesting to see what kind of impact it will have on the stock price performance, outperformers and underperformers alike.
Absolutely, Hormuz. Thank you very much. Very, very interesting. And thank you for putting out that data for us. Let me, Nirav, come back to you on this. And, the question is that I guess the sentiment in the primary market was only reflecting what we were seeing in the secondary market. A lot of these listings did go on to create a lot of wealth as well, right? And newer areas like EMS, or maybe some of the newer hospitals, something like a NetWeb. I mean, the lock-in is ended today on NetWeb. It's not like people are dumping the stock. It's actually up 2%. So how do you read the fact that so much fresh supply will come up for free trading in the market, coupled with the fact that we've had this dazzling mid-cap rally? What is it that people should keep in mind?
First of all, we need to differentiate between the cause and the impact. I'm very clear about it, right? So for example, there are a lot of good ideas and the investors come and ask us whether the liquidity event, right? So for good companies, please bear in mind that the supply will create its own demand. A supply overhang, so as to call, will only matter when your earnings are not coming. So I think, first of all, we will not confuse between, so if the underlying fundamentals are rock solid, I think, I don't think that supply will be an issue. A case in point is Indigo Airlines, right? So there is a very well structured process that has been laid out in terms of how one of the major promoters want to exit over the next 3 or 4 years. And, you've just seen about $500 million getting absorbed, almost regularly. We also need to bear in mind that, we are a very peculiar sort of economy, and the structure of the ownership of the promoter is very, very high. I think it's close to about more than 50%. Almost all the global markets will have far, far lower ownership structures. And if you want to see in terms of what's going to happen in the next 5, 6, 8, 10 years, you are likely to see that, the ownership of the promoter is probably will certainly go down, and the participation from the institutional investors and retail will increase. But in a nutshell, I just take it as a way of life. I'm not too overly worried about this.
Nirav, I want to zero in on the manufacturing companies. Q1 has been exceedingly strong for them, very good execution, their order book has swelled, and the companies have revenue visibility for the next few years. The question is, can the government, continue to allot orders at the same pace that they've done over the last 2 years? Or was there an element of a little bit of a pent-up, say over the last couple of decades because we've not spent so much? The question is, can we assume the kind of order wins that the companies have seen into perpetuity for the next 5 or 10 years?
Well, it's certainly not going to happen. For example, I mean, if you just look at the infrastructure sector, then large part of the infrastructure sector today consists of roads. And in roads, I don't think that you can have a sequential growth. Even if you keep on doing 5,000 or 6,000 kilometers a year, that is good enough. Obviously, there are, significantly new sectors that are coming up in terms of metros. And now we are talking about the railway sector because of this Vande Bharat trains and the deepening of the manufacturing. So I think that I don't believe that markets are looking at perpetual growth in infrastructure, but the fact that your investment to GDP ratio has, I think, inched up to about 29-30%, and if you keep on growing at about 12-13%, which is what the expectations are around nominal growth rate in GDP, that is good enough. What you certainly see a delta is in manufacturing capex and not necessarily only in the infrastructure. And that is, there are a lot of levers to that. It is obviously the fact that some of the sectors have become fairly competitive in terms of their export appeal. Auto ancillaries is, for example, a case in point. You know that some of the sectors are being driven by a very well template of the PLIs. And obviously now you got deepening of the manufacturing that is happening because of import substitution and subsidies that is given out. So there are confluence of factors over here. And manufacturing is where you can believe that you can have very high growth rates for a very long period of time. And in some cases, the valuations are reflecting that.
Okay, all right, Nirav, thank you very much. Good listening into you today. Thanks for joining in and sharing that perspective with us. Rima, we can have all the orders across India. We can have all the execution across the